Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of September 15th, 2024. And in this week's episode, I'm joined by fellow Blockhead Trader Viper XL 007, and we are going to take a look at options because, kid, you got options. We're going to take a look at what exactly is an option and what does that mean for you as a trader. And after we talk through that, we're going to take it down to a tangible real-world example in Apple, and we're going to show you 3 bullish thesis trades that you can do in a variety of options and compare it to longing those shares. But before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You'll also find a link to thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. Lastly, this is available in an audio-only format wherever you get your podcasts. So find this there, subscribe, and if you can't find it, let us know and we will get it there. But let's hop to this week's content. Viper, I wanted to take a minute to kind of almost going back to basics. And so I want to kind of tailor this episode a little bit more into somebody newer into the trading space, the investing space. Definitely more trading, I guess. I shouldn't have used the phrase investing, but a smaller account size and maybe somebody that is not familiar with options and they come from the traditional mindset of buying shares of stock and, holding them to a profit and then selling them and getting the gain. And the reason I want to do that is because there is interesting vehicle, it's a derivative called an option, which, tracks an underlying stock. And there's a lot of flexibility that this can give you. You can kind of define your risk, how much your max loss is. And there's different ways that you can kind of trade that vehicle. So I'll have you put on your beginner's hat because we don't have our hard hats yet. They haven't come in yet. I tried to Amazon them, but they're taking a little bit longer. So no hard hats this week. But I want to kind of take this from a beginner's example of this, and we're going to kind of assume a small portfolio before we hop into it. So I thought for this, we would focus on one stock in particular, just because it's a thing that everybody knows. Earlier this week, they had a event, right? Their Glow event. So this is Apple released new, information about their iPhone 16, the new AirPods, and just all that kind of product launch. And to be honest, it's kind of a staple as somebody thinks of stocks. Hey, how's Apple doing? And Apple is, there's an interesting thing that you might think. You might think, oh, Apple's expensive, Apple's cheap, right? And the one thing when it comes to stocks is you really can't look at the price alone to say, is that expensive or cheap? It's not like, you go to a grocery store and you say, wow, that gallon of milk is expensive. You say that gallon of milk is expensive based on the price that is attached to it because you have a value of what that represents. And so to you, that is either expensive or cheap, depending on what you value that gallon of milk at. And I think a lot of times people just have this kind of arbitrary number in their head when they're like, oh, $220 for Apple stock, that's expensive. Apple should be like $50 or something like that, right? Or they could say, that's really cheap. Apple should be worth $1,000. And I find that a lot of newer people to trading don't really, I'll say, think through what is expensive or not expensive. Have you come across that in other people that you've talked to that are new in the space where they judge something as expensive or inexpensive simply by the sticker price?
Oh yeah, absolutely. I mean, and I think it goes even deeper, beyond just people new to the space. I mean, it's a psychological thing, and there's probably very real reasons behind it, but it's all I can think of anytime there's a stock split. I mean, Nvidia, Amazon, Apple, anytime they do a stock split, I think, what was it? Nvidia just did like 10-1 or something like that.
Yeah, I think it was like 20-1. That was huge.
Yeah, it was something crazy. And I think there's like I said, there very well could be a mechanical, logical reason behind it, but I really feel like there's also a psychological reason behind it of exactly what you're talking about, of like, oh, it's $2,000 for a share, and well, it's $100 for a share. I could probably buy that, like, so yeah, absolutely.
Yeah. And so we're not going to get in this episode, how you measure the value, right? But you'll hear different things, price to earnings ratio. So you say, well, how much revenue does Apple bring in? And if you divide that revenue by the shareholders, what's the ratio of that price to every dollar that they bring in per share? And you'll find that that's a kind of a neutral comparison. P&E is what it's referred to as, right? And you'll get that forward PE, you'll get current PE. So like, what's their forward forecast of earnings? The price divided by the forward forecast, the price divided by the current earnings. And you'll even get it for the sector of like tech and things like that. Where I think it's psychological goes back to this. Hey, let's assume we got $2,000. You got $2,000 to invest in the market. And all of a sudden you look at Apple, that's, $222 a share. And you're like, well, geez, I just buy a couple of shares of Apple and I'm done. So that's expensive, right? I think that's kind of where it comes down to. I think people equate the price relative to the amount of capital that they have to spend just in their head, right, wrong, or indifferent. I think that's kind of what happens. Now, that also presents an interesting problem because maybe I feel that Apple is definitely a company that I understand and I want to trade, but I might only have $2,000 and I can't go to a lot of brokers and get partial shares. So it's not like, if it's trading at $222, can I buy 10 shares of Apple? Nope, I can't. I don't have enough money for that. I have to, scale it back to that whole number that lets me fill that. And I think the higher that price tag is, the less, granularity you have on whatever your max portfolio is. Now, some brokers absolutely do offer partial shares, and they do offer partial shares on a lot of actively traded companies. But for the argument's sake here in this episode, we're going to assume that you're at a broker that doesn't allow you to purchase or trade partial shares. So what do you do? How can you make that $2,000 go farther, or at least maximize or capitalize a little bit more on them? And that's really where the options world comes into play. And so the first thing I want to pull up here is what is basically referred to as an options chain. And first of all, an option is simply a coupon. And we've got other videos in the backlog of things around options. And so I'm not going to deep dive any one particular thing in this episode. We'll just kind of gloss over it a little bit or describe it at a high level. And so the thing about these coupons is not like a share. So when you buy a share, you have that share until that company goes out of business or until you sell it, right? That a share is forever, kind of like a diamond, until the company goes under or until somebody comes and offers you a price that you're willing to part with that share. Now, the share doesn't go away, it just trades hands. Options are a little bit different. Options expire. And so an option is represents the ability to purchase or sell shares of a stock within a given time frame. And so in this particular option chain, what you'll see here is you'll see some yellows and then you'll see some grays. Most options all expire on a monthly basis. So every month there's an options expiration. It's always the third Friday of the month. Now, when you're closer to right now, they actually release options weekly. Now, not every stock does it, but a lot of the high volume ones will have weekly options. And the weekly options will only go out about a month or so. And so that's what you see there in yellow. Those are options that expire on a Friday, but on a Friday that's not the third Friday of the month. And so the little number in parentheses before the number 100 represents how many days to that expiration. And once an expiration of an option hits, it's gone, it's done, it's worthless. It has no value anymore. And so your trade, your move that you want to have happen has to happen within whatever time frame. So this is the first parameter that we need to pay attention to when we want to craft some trade out of options is, when do I think the move that I think is going to happen will be done? So if you think the move of Apple is going to happen within the next month, you're probably going to pick an option that is less than, 37 days. So somewhere in a month time frame. If your move is a longer term move on Apple, you might go out 65 days, 100 days, 128 days. Now, this option chain goes like years. So I only grabbed a snippet of it. And that's the chain that you're going to want to drill into to see, okay, what can I do with this? So think of this as one of the variables or parameters that you can adjust is how good is this contract good for? So let's drill in. We'll just pick 100. So 100 days to expiration. So the options that are going to expire on December 20th, 2024. It's 100 days to expiration. And this is where you get kind of more data points. And there's a couple columns that I want to call out here. We're going to ignore the implied volatility and the probability of out of the money. Those are the percentages, the first two columns. And we're going to focus on this delta. So delta is one of the Greek values that an option carries. They carry multiple different Greeks. And what delta is about is it talks about how much does the price of the option change when the underlying moves by $1. And so, for example, this highlighted strike here basically says it's a 240 strike. And I'll talk about strikes in just a second. But this says that if you purchase this particular option for every dollar that the underlying moves, the option will increase by 33 cents. So you can think of this like 33% of a full share of Apple. Now, it's a little confusing because actually this represents 100 shares, but basically you get a third of the price movement when Apple moves. And the reason that's important is because you can leverage this delta to craft a little bit of what might be referred to as a partial share. And I'll show you what I mean. So if you had bought a full share of Apple and it goes up $1, you make $1. If it goes down $1, you lose $1. In the option world, if Apple goes up $1, the value of your option goes up 33 cents. And if it goes down $1, the value of your option goes down 33 cents for that particular strike. And so if you can't, get a full share, you're getting the price movement of a partial share, and you can kind of use less buying power. Now, what's important, and another variable to turn here, is the strike. So on the far right-hand column, you have the strike. Now, the strike price is basically where that option begins to really kind of grab a lot of price or value. So that is the price, the face value that the coupon is good for. So for example, if we are buying an option and we are buying a 240 strike, that option basically says I have the ability to buy shares at Apple at $240 if I wanted to. And if it's less than $240, I would never exercise that option because that would be silly. I can just buy the shares for whatever they are if they're less than 240. Now, if they're over 240, that's where it's very lucrative because no matter how far over 240 Apple is, I'm allowed to buy them for $240. That's what that contract is actually representing. Now, that coupon isn't free. You can't just say, oh, yeah, I want one of those 240 strike coupons, so give me 100 of them, right? They're going to cost you some amount of money, and that's what this bid and the ask price is. So the bid is what people are willing to buy them for, and the ask is what people are willing to sell them for. And so the actual price you'll end up paying will be somewhere in between those things. So you throw out a price and you see if, the bid or the ask, comes up or down to fill that order. And so let's just assume you kind of split this thing down the middle. You're probably looking at, $545 or $5.45. That's what it's going to cost you for the privilege to be able to purchase Apple shares at $240 anytime within the next 100 days. So if I was to buy this call and I would put an offer out there for $5.45, and let's assume it was filled, because this represents 100 shares and you can't do options contracts for less than 100. So every options contract stands for 100 shares. But what that means is if I have that, I will profit as if I was holding 100 shares of Apple and I only had to pay $545 for it, because that's the price of the option. Now, the drawback is if in 100 days we don't get above $240, I don't get any of my money back. I won't lose any more than $545. That's the maximum loss, but I won't make any money. There's no like, oh, you came close, so here's your consolation prize. When that expires, that option has zippo zero zilch value, unless, of course, it's over $240. So hopefully, Viper, you can kind of start seeing where this is interesting. Because remember, I said we only had a $2,000 budget here, $2,000 portfolio. And that's only 2 shares of Apple that I can buy outright, $444. But if I spent $545, I could control 100 shares of Apple for the next 100 days. So to get 100 shares of Apple, I would need a much, much bigger portfolio than $2,000.
Yeah. So, and this is interesting because this is, I talk when I do like price action on charts and reading charts and whatnot. And I talked last week about how in my own journey, I had to hear the same thing over and over and over and over again, or just hearing things explained different ways. And I just pick up little nuggets and pieces, and options are very much one of those things, that I constantly have to hear over and over. And I pick up little bits here and there. So one thing that in this perspective that hasn't really hit me before, is, so let's say $5.40 is your bid, and it gets filled. So $540 is what you spent up front to control effectively $24,000 worth of shares. So that feels like, to me, we're talking like, I mean, so the concept of leverage comes to mind, and particularly like 45x leverage because you're using $540 to control $24,000 worth of shares. So walk me through the risks, and just how someone would process the weight of that map.
Yeah. So I guess we'll let me comment a little bit on the risks, because some of the risks I'll start showing you on the next slide are the knobs that you have to kind of pay attention to when it comes to that. So I would say your biggest risk, well, you have 2 risks. Your first risk is how much money did you have to spend for the ability to buy those shares, right? And that's that $540, as you mentioned. So the reason that's a risk is because if the Apple stock doesn't do what you need it to do in that time frame, you have lost or will lose 100% of your money. So that's different, right, than in shares of Apple. Whereas if you bought 2 shares of Apple and it doesn't do what you want it to do, unless Apple stock goes to 0, you're not losing 100% of what you put into it. And that's your downside, I guess, risk here is, one, it's a benefit because you know exactly what your max loss is. You cannot lose more when buying a call like this than what you paid. So that's kind of the first end risk, right? The other risk you're going to have is options expire. Well, guess what? The value of the option, when I say the value, the price that the option is trading at, takes into account how much time is left. And so the less time that is left, the less value is in the option from time, which basically means options decay over time in value. So the more time passes, the more of that value comes out of the option, because when it hits expiration, it has to be 0 by definition. And so if you don't get your move that you're looking for right out of the gate, your risk kind of, you keep losing more and more money waiting for that move, because that value is slowly decaying over time. Now, that's where I think some people get a little bit, let's say, overwhelmed in options, because there's lots of things that go into the calculation of what is that price that is at that bid in the ask. And that's kind of the next thing I want to touch on a little bit, is there's these other Greek values that go into that option. There's basically kind of four big ones. And I'll touch on a little bit of what they are, although we do have past episodes. I'll put a link probably to, I'll look for a good one, and I'll put a link in the description below on which one might kind of cover some of these Greeks. But the first one we talked about, the delta, that is the amount of price that the option moves for every dollar that the main stock moves. The other way you can view delta is the probability of hitting that price. So for example, statistically speaking, because a lot of the options are derived from mathematics and formulas. So if this 240 strike we talked about, it has a 33 delta. That can also be stated as there's a 33% chance that Apple stock will be at 240 or greater in 100 days. The flip side, if we come down to $200, there's an 80% chance that Apple stock will be at $200 or greater in 100 days from now. And so you can think of delta also as a percentage of where might that be as far as the price of Apple. So sometimes people look at options pricing to gauge where the market thinks something is going to go, because it's not an even distribution around the current price. If things get incredibly bullish, you'll find that these delta percentages get higher and farther out on the top side. So you can use this as where does the market think the stock is going? The next column we're not going to touch on, it's actually even cut off, but it's called gamma. So gamma is really the rate at which delta changes. And it really only comes into play in naked options, and it really only comes into play close to expiration. So that is the rate that delta changes, but based on how much the price moves. So because this is 100 days out, there's actually almost no gamma impact whatsoever, which is why they're all listed at a penny here. If we were to look at something in 1 day expiration or 3 days expiration, you would see a distribution of gamma. But that's what that one is. Now, the next column, this is the other one we kind of touched on, where I talked about that time premium, that decay. So that is the theta. And this is where the option is constantly working against you if you're the option buyer. So the way you read this now, because there's lots of time, the theta is not decaying very fast. The closer you get to expiration, the faster theta decays. But the value that you see here is how much the option price goes down every day. So assuming price doesn't change at this 240 strike, tomorrow there will be 6 cents less than today. And the day after that, it might be 6 cents later than that. And as time goes by, that theta number will go up and up and up. So when I talked about the risk, it's kind of an increasing risk. It's like rolling down a hill. When you start rolling down the hill, you're not going too fast. But the closer you get to the bottom, the faster and faster and faster you're rolling. And that's kind of that option price decay. At first, it doesn't decay very much. But as you get closer and closer to expiration, it starts decaying faster and faster and faster, because it's got to get to zero by the time the option expires. Now, the very last column is called Vega. Not really going to get into that, but that is the price impact that volatility plays on the option price. So if volatility increases, then the option price will increase by this percentage amount. And I won't get into the formula, but you can kind of negate Vega and gamma if you're new at this, and I would only pay attention to delta and theta.
So yeah, and again, another nugget. Vega is one that I hadn't really known before, but that makes sense now. How that somewhat factors in, and I can start to see some potential strategies where you might want to pay into that or pay attention to that. But what I'm hearing and what I want to impress upon any new people hearing this is, because we're talking about calls, because we're talking about buying a call, having that defined risk. What I'm hearing is the moment you buy that call, it feels like there's a lot moving against you, and a lot that maybe almost like you're off to the races once you buy that call. Is there any truth to that?
Well, I'll try to answer this with as little subjectivity as possible, because I am biased to selling options, not buying them, because of that point that you just raised right there. Is there is quite a bit of factors moving against you. However, we do have some traders in the Discord who, they got their price action charting in, they've got it dialed in, and they know the move that they want to see, and they want to lever really hard on that move. And if you are aware of how that option ticks and how it's going to work against you, you know that, once you enter that, you need to see your move or invalidation, and you need to get the heck out. It's not like you can wait for a recovery or get a buffer. You have to really plot your exit, and you can really control your downside risk. So I said you can lose 100%. But that's if you hang in till the very end, just kind of hoping and wishing, right? If you have a price action setup and you have okay, if price goes down from here to this level, I need to get out, because your option's going to lose value and you got to cut your losses really quick. Now, if it goes in your favor, you'll see in the next example that I'm going to lay out different plays, you can really return a lot of return on very little upfront thing, because a lot of people that buy them, they view it as a huge benefit because they're controlling the downside risk, because they know the most I can lose is what I paid. I personally think that a good risk mitigation trader can control his downside risk in shares or anything, right? It's just, when do you cry mercy? So if you were trading raw shares, you're going to set a stop loss for your order and you're going to bail at a certain price, right? You're not going to just buy them and hang on and hope, right? But if you're the type of person that's going to buy on and hang on and hope, there's a lot working against you in an option, because it's going to go to zero. Whereas you get kind of cushion if you buy shares. But I would say, back to the original question, yes, there is quite a bit of factors stacked against you. But the converse of that is, the greater the risk, the greater the potential reward.
I don't bring that point up to try to scare anyone away. I think, especially for people new to the market, especially people new to different mechanics and things like that, I feel like, for me personally, so maybe for one person out there, it's really important to view these tools as tools, and as professional tools, if you will. And so, like a professional kitchen, and you have a super sharp professional knife or whatever the tool is, every tool can be dangerous if you don't know what you're doing with it, but every tool can be used in an extremely efficient and proper way. And so I kind of, that's how I view a lot of these things. Pretty much everything we talk about on this show, certainly options, certainly calls versus puts, like Sprocket called out there. He's a put seller, and that's a tool, that's a function, that's a thing. Buying calls, that's a completely different tool for completely different mindsets and strategies.
Yeah, I'll just sticking with your analogy there of tools. The image that comes to my mind is, you go to a nice fancy restaurant, the steakhouse or things like that, and you got your fork for your salad, you got your spoon for your soup, and then when they bring out your steak, you get a sharp knife. And sometimes they give you a different fork, a bigger fork, right? But think about it. What if you go to that same restaurant and they just give you a spork, like the kind you had when you were in elementary school?
Plastic.
Could you eat the steak with it? Yeah, I guess. But is it going to give you the same efficiency, the same experience? No, it's not. And I think that's really where all of these different tools that we talk about are the different utensils that you might use given what's presented in front of you. So let's take a look here at 3 different ways to trade Apple a little bit. Now, we're going to stick with that. Hey, we got $2,000 portfolio size. Right now, Apple is trading at about $222, and our thesis is Apple's going up. I have no idea what the heck Apple's doing in the market. I haven't done any price action charting on it or anything, but for this example here, let's just assume that we think Apple is going to go up. Now, I'm going to talk you through each of these scenarios. The first one is buying a call. Second one is selling a put spread. We didn't talk about these mechanics. I don't want to make this video hours long, but if a call is, buying a call is bullish, there is a flip side of every option trade, and selling a put is also bullish. Now, because Apple, to define your risk, you also then have to buy a put to kind of protect yourself. That's what a spread is. It's selling a put and buying a put that's further out in the money or further away from the money. And that will define your risk. And I'll try to find a link for one of our put spread episodes and also put that in the description if you want to learn more about that. And then the last one really shouldn't need much explanation. It's just buying straight shares. So let's talk through each of these. First one, buying a call. So this is where I talked about, let's pick a strike. In this case, let's say, the way I picked all of these is I assumed, let's try to spend about $500, plus or minus, but let's say, hey, I don't want to spend my whole portfolio on this trade, but let me do, a little chunk of it. So let's say it's a $500 is my budget for this. If I look at the option price, the 240 call, it costs $5.45. Now, it represents 100 shares, so I am going to pay $545 to basically control 100 shares of Apple, but that really only starts getting value when you get at $240 or more. Now, if you get to $241, do you make money? No, you don't, because you had to spend $5.45 on it. So you really don't start making money until you get over the strike price plus what you paid for it. So in this case, we really start profiting once we get over $245. Now, the benefit here is for every dollar that we go over $245, you make $100. So if Apple goes from, 246 to 247, that's a $100 gain on your option. And that's really where this thing starts to grab and gravitate towards. So what's the probability that you're going to be over $240 at expiration? About 30%, 29%. I think the options pricing changed from when I took the screen grabs to when I made this table, but it's roughly a third is your chance of being right. So the next one is selling a put spread. Now, I won't get into the mechanics here, but basically you're going to sell a put, and then $5 out, you're going to buy a call. So the most you can lose, this is defining your risk. The most you can lose is $500, the difference between the put and the call. And when you sell that, you're going to sell it for some dollar amount. Now, in this example, this spread was selling for about $1.10. So I can collect $110 on this play, and I have to pay. You don't really pay. It's only if you're losing do you have to pay that money. And basically, if the price stays above $205, you don't lose anything. But you have to put up that $500 in buying power to have this trade open. So as long as it ends in the profit out of the money for you, then you're golden. You keep all that money. You don't have to spend that $500, but you will get $110. Now, the chance of this happening at the time that I made this table was a 72% chance that this was going to finish for $110 or greater. And this goes back, Viper, to that risk reward that I was mentioning. That you'll notice that in the previous example, the chances of winning are quite low. So your risk is pretty high that you're going to lose this $545. But if you're in this chance window, your rewards can be very, very great, as you see down in the table below. Now, this put spread, your chance of winning is very, very high. So you're not really taking on a ton of risk. So guess what? Your reward not going to be as great. but it's more consistent across the board. So Apple stock could go down 10%, up 0%, up 10%, up 20%, and you walk away with $110. Whereas on the call, you lose $545 if it goes down 10%. If it doesn't go anywhere, you lose $545. If it goes up 10%, you'll actually end up losing $80 because you won't quite clear that $245 threshold, but you'll be kind of close. So there will be some intrinsic value in the option because you'll be over your 240 call, but not past your other one. So, you lose a little bit. But if it goes up 20%, look at that, Viper, $2,140. And that goes that risk and reward. There is a low chance that that's going to happen. But if it hits, you spent $545 and you return $2,140. Big move there. Now, the very last one that I'll cover is what everybody kind of has a mindset of, and that's buying shares. So great. How many can you buy? Well, for my $500 price target, I can only buy two, $444. 3 would take me to $666, and that's just too far over. So, okay, kind of stinks. Only can buy 2 shares, which basically means I will profit because I bought them at $222. I make money for every dollar I go over. I lose money. I make $2 for every dollar I go over, and I lose $2 for every dollar it goes down. And you got a 50-50 shot. Any buying of shares is a 50-50 shot on, are we going to go up? Are we going to go down? So if we go down 10%, you're going to lose $44. If we don't go anywhere, you don't lose anything. If you go up 10%, you make $44. You go up 20%, you make $88. Very, very linear. And that's really where all these stack up. All of these ways, these are 3 different methods to basically make a trade on Apple is going up and what the outcome of that trade is given the strategy that you've chosen.
So this highlights one of the things that I struggle with on that risk front, and that is, while the window is very small and the odds therefore are very small as well, in the put spread column, and again, hopefully the question isn't lost on the viewer because we're not getting into the entire mechanics of the spread, but what happens at expiration and the price is $203, right in the middle of that spread?
This probably might be confusing to some of the new viewers, but remember that what the options stand for here, and a put means somebody can put shares to you for $205 at expiration. So the options themselves have no value. So in your example, if we're at $203 a share, that option will exercise and you will be forced to buy those shares at $205. Now, you don't necessarily have to have the money to buy those 205 shares, because if you don't, what will happen is your broker will turn around and sell them right away on the market. Okay. So you won't actually hold them. So you'll buy them for $205 and then you'll turn around and sell them for $203. So your loss there would be the difference between 205 and 203, or $200. So you would lose $200. Now, the other option, the $200 call, that is out of the money. So it has no value to you. So it just expires worthless, which is why you end up turning around right on the market and just dumping the shares. And that's why you would be out that money. That's why the broker will hold $500. Because hypothetically speaking, right, if that stock price dropped to, say, $100, okay, you would need to be able to basically sell the shares back at 200 because you own that call, right? That's your downside mitigation. You can't get any lower from that. So even if the stock was at $100, yes, you'd have to pay 205 for it, but then you have a coupon that automatically lets you turn around and sell those for $200. So you will automatically be out that $500. And that's why the broker will hold that money just in case they need to cover that in the case that it drops down below. And then if you're in that no man's land in the middle, you don't use your downside protection, but you would just turn around and dump them back on the market. So Viper, that's really kind of an explanation there of different approaches to things, and hopefully that kind of highlights how you might use some of these tools or these techniques, let's say, where you if you really want to kind of lever up, that's really where buying options can kind of come in play. Now we did calls because we were long. The same holds true for the downside, except you would substitute the word put everywhere you see call. And if you wanted to play the reverse on selling them, you would substitute call everywhere you see the word put here. You can just flip them and then you'll get a trade in the other direction. Hopefully that gives some sort of tangible, interesting things that you as the viewer can go out and kind of look at, Google, learn more about. Don't just discount options as too complex. I can't figure them out. Try to find different videos, try to read up on them, go back in our own library. We've covered many pieces of them, because I really think that the derivatives that options put out there, for lack of a better term, gives you options, gives you flexibility to really craft different approaches and techniques to what is happening on the price action. And then really depending on where volatility is, maybe that also can play into your strategies. I know for me, one of my huge things is to sell options, but I don't just sell any old option, right? The reason is because that price can grow really fast when it comes to volatility. I know we didn't get into Vega, but that Vega number, that volatility number, so if a stock and an option is very low in their historical volatility, there's a high probability that volatility is going to expand and increase. And when volatility expands and increase, so does the option price. So as an option seller, I don't want to touch those. But if you want to be a leveraged buyer, you might go buy options when volatility is really low. Now, the flip side there is if volatility is really low, the probability of big price swings is very small because, well, there's not a lot of volatility. So I know in the trading Discord, I will call out a lot of volatility alerts saying, hey, volatility is really high on this. You might want to look at selling premium. And we got a trader in there who I'm pretty sure just uses that as, ooh, that's a price action I want to play. And he'll trade straight shares on that because he knows that if volatility is high, that the price is going to be moving. And he's a scalper. He likes to scalp different price levels and different movements. And so he takes my volatility alerts and then goes and sees, hey, what does the chart look like? What's the price action look like? Can I buy and sell shares on this? Because he's swing trading it. Where, other traders look at it and say, oh yeah, I might sell some options on that because volatility is really high. So it might be contracting. And so we're all making plays on the same underlying with different techniques and different tools. And that's really the essence that I want to get the viewers to walk away with here.
So in my attempt then to summarize, if somebody heard this and is like, you know what, I'm still a little nervous, but I think I track it. I think I'm interested. My tangible next steps, and Sprocket, go ahead and either confirm or completely rebuke or whatever is inspired by this perspective. If somebody wants to get in, first of all, obviously, as has been shown multiple times on the show in various arenas, I'm a huge fan of tuition, which is the really nice way to say losses. And what I mean by that is learning by losing. You don't set out to lose, but you accept you're probably going to lose. And so tying that to a tangible entry point for anybody looking to get into options, my first entry, potential entry is buying, like we talked about, buy a call or buy a put. First, understand what you're doing and which direction you want the underlying to move. Obviously, don't just throw money at it and just hope it works, but also accept that whatever that option contract is costing you, make sure it's within your tolerance of just straight up lost money, because you're the whole goal of this exercise on entry is to touch the machine, and you can, with this mitigated risk as far as how much you're paying for that option, you can control how much that that loss, potential loss, hurts or doesn't hurt. So buying naked, which is just buying a call, buying a put, I feel like that's your first entry. Price it out so that, like I said, everything I just said. The second one is the spread. Look into different types of spreads. The put spread that was called out here was just one type of spread. There's lots of different spreads, but don't get into like all of the, like, put spread, call spread. Start there. Those are the two easiest to understand once you understand buying the call or buying the put. And then just kind of hold there, because both of those have very, very, very well defined and contained risk parameters, as you saw in the chart there. So that would be my recommendation, is touching those two mechanics and looking at that cost up front, accepting it as potential loss, write it off in your head as loss, even though, again, you're doing your due diligence to try not to lose it. And then lastly, do not touch naked selling. Naked buying is one thing. Naked selling is just save that for a whole nother ball game. There's a lot of loss potential in naked selling, which is why spreads exist. So buying or spread would be my two recommendations.
Yeah, I'd give one tweak to that. I think you're spot on if you want to see it and touch it, feel it, deal with it, buy a call, buy a put, target underlyings that are under $30, something like that. I think you'll find that the option chain are in the pennies. So we're talking probably options. You could buy a call for $10. You could buy a call for $3. Go there. That definitely, I agree with that. Next step, spreads, put spread, call spread, 100%. Yep, look at that. Where I would deviate a little bit from you is the naked part. So I do agree, naked calls, don't touch them. Don't even think about them until you are an experienced person. That is the scary, scary stuff. Naked puts, if you know what they are and you're willing to buy the stock and you have the cash to buy the stock at the put price, they're perfectly legit vehicles, and I don't think you need to shy away from them. We've definitely talked about, using that as kind of a getting paid to wait limit order. So if you want to buy the stock at, $50 and it's trading at 60, and you sell a put for $50 and you get assigned, you got to be okay with that, because you were willing to buy the stock at $50 anyway. So that's the only caveat, the only minor tweak I would get. Now, if you don't want to buy the stock, don't touch it. Don't trade naked if you're not going to buy the stock. But if you do want to buy the stock, then I would put that as the category number 3. So your first priority is right. 1, buy a call, buy a put. 2, spreads. Buy them or sell them, doesn't make a difference. Then next one, naked puts if you're willing to buy 100 shares. If you're not, then don't touch them. And then naked calls, just don't touch them.
Yeah, that's fair, because I do think there might even be an episode labeled naked puts. We talk about it enough that it wouldn't surprise me if we had that. But yeah, I guess it's very fair to include that, because as was said in the many episodes we talk about that, we actually talk about naked puts as the best entry into options. So it certainly fits in this conversation. And like you said, it fits specifically if you are okay buying 100 shares of that underlying, then go for it, but 100 at a time per contract. Don't go be like, hey, I could get $5 on this naked put, so I'm going to sell 10 of them. Well, you got 1,000 shares coming your way potentially.
Yeah, definitely. And the only reason I put that at number 3 here, Viper, is because we're talking about tuition. We're
Yeah.
talking about making mistakes.
Yep.
And so I do firmly believe that naked put selling, if you're willing to buy the shares, is an excellent entry point. But we're talking about understanding how the Greeks move, understanding how they go, keeping our tuition low, and naked puts will be a more capital intensive tuition.
Yeah, for sure.
Well, that brings us to the end of this week's episode. Kid, you got options. So don't just take trading as, oh, yeah, he buys and sells shares. He's amazing, right? There is so much more to the world of trading. There are so many other vehicles. There are so many other ways to express the different vehicles. Options are one of my absolute favorite techniques to leverage, and it really doesn't have to be as scary as people make it sound. Once you start getting into them and understanding them and touching them and feeling them and just doing it, I think you too will learn the same thing. And you can see that there are different things for different situations. You know, we laid out 3 different ways to play a bull thesis on Apple, and you can see each one of them has a dramatically different outcome, and each one of them had a dramatically different risk profile as far as what could you lose, what could you gain. In that old adage of the bigger the risk, the bigger the potential profit, but the lower the probability, that 100% holds true across the board, no matter what it is, right? If you want, a more guaranteed return, your return is going to be lower. If you want a less guaranteed return, but the potential for making bigger money, yeah, you're going to take on risk. There is a direct correlation to risk and reward. More risk, more potential reward, less probability. Less risk, less potential reward, higher probability of working. It all is a balancing act, and just kind of knowing it all, understanding it all, that's really where the magic kind of comes in. And the only way to do that is to really hop in yourself and learn it, experience it, and know it. Don't just listen to a couple of yahoos on the internet and call yourself an expert. Get out there and try it. So good luck to you. Hopefully some of this strikes home or perks a curiosity for you. I hope you enjoy what you're trading and you find something that interests you. So good luck, and remember, think outside the block.